I have now the distinct pleasure and honor to introduce Mr. Timothy Adams, the President and CEO of the International Institute of Finance. After a long and distinguished career in the public sector, which included time in the White House under President Herbert Walker Bush, as well as time spent as the Chief of Staff to both Secretary of Treasury John Snow and Paul O'Neill. He's been leading the IAIS. So welcome, please.
Thank you very much, and good afternoon to all of you. Happy birthday. I didn't get a chance to have the birthday cake, but it looks delicious. Maybe I'll get some at the conclusion of today's remarks. Let me thank Secretary General Dixon and Dr. Saporta for inviting me here today to address you. It really is an honor, and I say that with great sincerity. Like the broader financial service industry, the insurance industry and its regulators are starting to shift focus from what happened from prudential regulation to one of implementation, while also scanning the horizon for new risks. That's a topic that we spend a lot of time thinking about and engaging at the IIF. The IIS is monitoring this risk-changing environment. And much of what we heard from my good friend Randy Quarles just a few minutes ago, Randy and I served in two different administrations together. We're long colleagues. And the transformation that is occurring under his leadership at the FSB and also at the Federal Reserve, this movement away from looking in the rearview mirror to one of implementation, and for Randy's perspective, one of focusing on efficiency and simplicity. Unfortunately, some people interpret efficiency and simplicity as deregulation. That indeed is not the case. It is really looking for better and more efficient ways to achieve the same shared outcome. But the IAIS is undertaking the same journey. And these meetings here in Abu Dhabi, UAE, mark the beginning of this journey. And we heard from earlier the ambitious plans for the next several years. Given that we are here in Abu Dhabi in the UAE, let me also offer my thanks to Sultan Al Mansouri for the gracious hospitality that you have here. The first time I came to the UAE was in 1999, 30 years ago. And the transformation that's occurred in this amazing place is truly breathtaking. There are very few places anywhere in the world that you've seen such a change that has occurred. And it really is under the leadership of this current administration, and I think one that will continue to be transformed in the years ahead. As Randy noted, it's fitting to be here in the Middle East because it is the birthplace of insurance. And he did a very good job of articulating some of the historical foundations. But it didn't end here. And over the centuries, we've seen insurance, the pricing of risk, the making of a risk market, and the development of risk products evolving and oftentimes lurching ahead. For example, the Great London Fire of 1666, where 30,000 homes were lost, or Hurricane Andrew in 1992 that changed the reinsurance market. And then, of course, we've seen changes in technology, just shipping, the evolution and changes in the way in ships and shipping has occurred, and as a result, more sophisticated, accessible maritime and cargo insurance. So whether driven by crisis or a changing landscape, the industry is always innovating and expanding into new products and services, such as today's comprehensive cyber risk prevention insurance. This innovative spirit and importance of the industry as a critical financial intermediary is why we at the IIF have built such a robust insurance practice, which is currently under the competent leadership of my very able colleague, Mary Frances Monroe, who's here on the front row. I know many of you know her, and she has done a remarkable job leading that effort. We have the top 30 largest insurance companies around the world as very active members. As President and CEO of the IIF, I spend most of my year traveling around the world. I actually fly about 250,000 miles a year and live in a fog of jet lag. I know many of you suffer from the same experience. And I go to see our CEOs and our chairmen and the heads of our institutions, and I ask them I ask them two questions. One, are you a happy client? And two, what keeps you up at night? And I do that with our insurance companies like Allianz or Swiss Re or MetLife. And the responses tend to cluster around a constellation of responses. And they are, as an example, cyber threats, how to embrace disruptive technology and the need to modernize legacy systems, an arms race of technology, which I'll talk about in a moment, the challenges of operating in a volatile macroeconomic environment, and the existence of low interest rates. We used to say low for a while, now we say low for longer, and maybe we'll say low forever. The impact of trade pressures, shifting supply chains, and geopolitical uncertainties, and the managing the risk of exposure to climate change, which I'll close on, but I know is the topic of conversation for next year's meeting in Santiago, Chile. Several of these concerns are perennial and represent risks that are largely out of our control. For example, our capacity to reduce political risk is at best limited. But for today, I want to focus my attention on just one of these concerns, which is the overarching theme of this conference, which you see in the agenda, it was laid out earlier, and the need to embrace emerging technology. You know, I first came across the idea of embracing the digital revolution when I started this job about 5 years ago, and we had a conference in Paris. And I had to go from one building down the street to another meeting, and it was raining. I didn't have an umbrella. And I picked up a Financial Times, and I used it as an umbrella. I put it over my head to shield me from the rain. And I popped into a little cafe going to my next meeting to have an espresso, and I looked down, and there was an op-ed by Peter Sands, who was then the CEO of Standard Chartered. And the title of the op-ed was entitled The Spotify Moment. And what he posited that what was occurring with respect to publishing and music, Spotify being the music streaming business, it was going to happen to financial services. And you were either going to embrace digitization and learn how to survive with it, or you were going to be left behind and be disintermediated. So with that, we launched a very robust digital practice and a set of issues which I will delve into momentarily. I also will, again, talk about climate change before I conclude with some thoughts about how we, the industry, can work more successfully and effectively with you. But first, there is no question that financial services firms know they need to adopt new cutting-edge technologies and accompanying new business strategies that go with those technologies. Why? Well, you got to serve clients, manage risk, control costs, and evolve the business model. It is the topic of every conversation, every board meeting, every industry conference, just like this one. The challenge is to figure out how much to invest, where to invest it, and ensure that you're investing enough to stay modern and at the cutting edge. In this rough and tumble world, where new disruptive market participants are clawing and scratching their way into the mainstream, current incumbent firms need to act boldly to deploy the latest technology to embrace new clients or keep current clients, develop new markets, and identify and manage new risks. One such technology is machine learning. Our very capable IF digital finance team has found that the adoption of machine learning has increased significantly over the past year. We do a number of surveys. We've done a survey on the use of machine learning with respect to credit risk, machine learning with respect to anti-money laundering. But we've seen it more and more as an application. The sophistication of machine learning models and the breadth and application across customer segments has grown substantially. The adoption of machine learning techniques continue to deliver tangible benefits to financial institutions, including improved model accuracy, the ability to overcome data deficiencies and inconsistencies, and the discovery of new risk patterns. In addition to the adoption of machine learning and AI, financial service firms are increasingly migrating to the cloud. One of the many future finance developments is being studied by here and by us at the IAIS. We welcome the discussions among supervisors of both the risks and benefits of migrating to the cloud and outsourcing, including the important risk of not migrating to the cloud. And we appreciate the need for a robust governance, due diligence, and contingency planning and exit strategies with respect to adopting cloud solutions. We likewise welcome supervisors themselves adopting new technologies, including cloud solutions. As Hugh Van Stennis, who was at the Bank of England and is now at UBS, wrote in a study released this summer entitled The Future of Finance, which Vicky Supported was a part of, The bank should be, talking about the Bank of England, should be a world leader in the use of digital regulation for identifying macroeconomic trends, financial surveillance, and supervision, but also at the cutting edge of using technology for supervisory purposes. Across the financial services sector, we're seeing a decided shift away from viewing the modernization of legacy systems and the adoption of new technologies as simply sunk cost, and towards exploring how the adoption of new technologies can both benefit the bottom line and advance societal interests. In the insurance sector, there are endless ways for insurers to invest in and harness new technology for their businesses. Machine learning and AI are transforming the entire insurance value chain. For example, technology can help life and health insurance better understand and price risks through the use of wearable devices. Life and health coverage can be expanded to underserved markets through digital platforms that allow customers to access insurance through their mobile phones or smart devices. AI solutions can help screen patients and detect diseases, which can prove life-saving in regions with limited trained medical staff. And finally, machine learning and artificial intelligence can be deployed to detect and combat fraudulent insurance claims, benefiting insurers' bottom lines, as well as managing costs for customers. To be sure, data privacy and data ownership are important considerations as a part of this discussion, and these concerns are growing more pronounced by the day. In fact, rarely do I have a session or a conversation or a conference or a board discussion that the issue of data ownership, data privacy, or data localization doesn't become central to that conversation. And in fact, it may be the defining topic of our generation as we move increasingly toward data privacy at a time when actually sharing data and information across jurisdictions is important from a supervisory and regulatory perspective. But we think with proper transparency, safeguards, and balanced privacy regimes, that we can move forward to respect privacy and broaden the range of products that are available to individuals. There are also concerns about inherent biases in machine learning and AI tools. Most data collected by human processes will have a risk of bias. There's no doubt about it. However, this risk can be mitigated as financial institutions improve their model accuracy and address data deficiencies through concerted efforts by key technical, business, and control functions. Our work on ethical implications of machine learning solutions conducted earlier this year highlighted how a comprehensive digital governance framework can mitigate bias risk. If you haven't seen our study on ethics and machine learning, I urge you to do so. It's available on our website. On the P&C side of the business, technology can advance better modeling for catastrophic events that are expected to increase in frequency and severity due to climate change, which I'll come to in just a moment. Catastrophic risk modeling has become increasingly sophisticated since the days of Hurricane Andrew, and modeling techniques are being leveraged to address climate challenges, recognizing, of course, the inherent limitations of historical data when it comes to attempting to model climate change or model the climate. As modeling techniques continue to be refined, insurers can better price risk and determine optimal levels of risk transfer. Reinsurers can better price reinsurance coverage, and with better information and modeling, insurers can enter higher risk, underserved markets with a better degree of confidence. Technology can also help insurers offer access to agriculture and crop protection products in remote or poor regions through parametric insurance offerings that facilitate the prompt identification and payments of claims for farmers who can't afford a lengthy claims process and as a result often forego coverage and thus suffer devastating consequences. Technology can also open the door to new forms of insurance and expanded coverage options. For example, the cyber risk insurance market has surged over the last several years, and I think will prove an exciting and innovative and rapidly growing product line for years to come. I understand that cyber risk insurance is the subject of an IAIS attention and a new IAIS working group, and we look forward to presenting our work on cyber risk underwriting to this group in Washington, D.C. next week. Cyber risk prevention and preparation services are becoming an integral part of cyber insurers' value proposition and the development that benefits not just insurers and their customers, but society as a whole. especially if the incidence and severity of cyber attacks can be lessened. Technology has also helped on the cyber resilience side by providing insurers with new tools to protect themselves from cyber attacks. I see that cyber resilience is on the agenda for tomorrow's discussions, and we've been an active player in the cyber resilience space, including a very active partnership with McKinsey. And again, we've done a very good study on cyber resilience, a joint study, and that study is on our website as well. Allow me now to shift to my second topic, and that is climate change. A topic dominating research, global gatherings, headlines, Twitter accounts. It doesn't matter where I go. I just spent Monday and Tuesday in Johannesburg. I was in Dubai yesterday. I'm in Abu Dhabi today. No matter where I go, the topic of climate and sustainability tends to dominate the conversation. In fact, it is the fastest growing work stream at the IAF, and we are struggling to keep up with the demand for just the knowledge of and understanding of what climate risk means. In fact, we launched our Sustainable Finance Working Group just 18 months ago, and the group has rapidly expanded to over 150 members, including the world's largest insurers. For insurers, sustainability extends beyond the asset side, which garners a lot of attention, but also to the liability side of the balance sheet through the development of new insurance products that support the transition to greener environment and help calculate, price, and manage the potential risks from more frequent and violent weather events, also things like rising sea levels, or the potential for new population migration patterns. In fact, there's a poster right outside the door here, I guess for the group next door, that posits enormous challenge of population migration patterns as a result of climate change in ways in which we haven't really even begun to think. Recently, the Bank of England Governor, Mark Carney, a dear friend of mine who's cycling off as governor, said in an address during the UN Climate Summit, and we had a very large group at the Climate Week in New York, he called on insurers to help close the protection gap that affects many emerging market countries that are at most risk from climate change, and to help fund sustainable energy and resilient infrastructure projects by utilizing the considerable investment portfolios. The bank has also, just like last week, addressed this risk side of the equation by calling for insurers to assess the adequacy of their exposure management and risk mitigation strategies, noting the dynamic nature of some of these key perils. Insurers have a unique ability to respond to Governor Carney's calls for action in a way that also provides new business opportunities across the full spectrum of insurance firms. For example, our IAF insurance members have committed to green investments in green bonds, and there's huge demand for green bonds, green infrastructure projects, and impact funds. But there's much work to do. For example, there's no definition of green. So you may have a green product in Stockholm or Cairo or Singapore or Beijing, but there's no guarantee that it all means the same thing. There is not a common taxonomy. There's light green and dark green, there's medium green, there's light blue, dark blue, and we at the IAF are leading an effort along with others to come up with a common standardization of what is green so that we can avoid accusations, potential accusations of greenwashing. In closing, and with these opportunities in mind, I want to highlight just how you, the IAIS, and the IAF can work together. Looking back on the last several years, it goes without saying the post-crisis reform crafting era has been challenging, and the journey was not easy for you or for us. We recognize and appreciate your many achievements, which were noted earlier today, and it's really quite amazing. The hard work and the earnest and professional manner that all of you exhibit, all in an effort to protect policyholders and to ensure the financial stability of the insurance industry, a key component in the global financial architecture. Your expertise and unique insights were a critical input into the G20 and the FSB's broader regulatory initiatives, as Randy Quarles noted earlier this afternoon. Accordingly, we, the IAF and the industry, commend your adoption of a holistic framework for the supervision of systemic risk. We commend a comprehensive common framework for the supervision of insurance groups. We commend robust insurance core principles. and the version 2.0 of the insurance capital standard for the monitoring period, and we look forward to working with you during this monitoring period for further refinements. Looking to the future, it is important that regulation and supervision adapt along with the industry to these new changes and opportunities. Regulations and supervisory standards should not be sclerotic, certainly not in such a dynamic environment, nor do I think they will. Like the industry, regulators and supervisors need to be nimble and open to understanding and embracing the next innovation of technological change. In particular, as the IAIS looks at challenges of supervision in the digital era, we would encourage you to do several things. One, assess the current regulatory framework in a way that identifies gaps and considers how other relevant regulations, for example, data privacy regimes, interact with insurance supervision. Two, use a risk-based approach that is proportionate and based on materiality. Three, adopt a dynamic, technology-neutral approach to new technologies. I always quote Deng Xiaoping, it's not the color of the cat that matters as long as it catches the mouse. So we hope that we can be technology neutral. Four, create incentives for firms to adopt guardrails and controls for the use of new technology as part of a robust governance and risk management framework. Five, pursue an activities-based approach that supports a level playing field among all firms engaged in insurance activities. Same activity, same rule book should apply globally. And lastly, support global and cross-sectoral harmonization of standards, but of course recognizing that there are situations where a bespoke approach is needed. Finally, I think it's axiomatic to say that a principles-based approach to regulation is particularly well suited to a dynamic environment and can be complemented by active supervision and guidance that evolves over time and can be readily updated without the need for lengthy legislative or rulemaking processes. One example from the IAIS experience on the application of machine learning is the importance of stable, near-timeless regulatory principles complemented by examples of good practices that can be updated periodically. Best practices recognize the fact that there is no one single pathway up the mountain. There is no one or right way to do things. So think about the robust application of best practices. The IF looks forward to continuing to engage with the IAIS, especially with the launching of a new 5-year strategy and a very bold digital plan, not only for this year, but going forward, that focuses on the future, on new risks, new challenges, and new opportunities for insurers. Thank you again for inviting me here on your 25th anniversary. It's been a great opportunity to interact with you earlier today, and I really appreciate this opportunity to be in front of you. Thank you very much.